Using candlesticks to determine the price action for one or more assets is a popular practice in technical analysis. The shape and position of a candlestick can signal a trend reversal, continuation of the established movement, or a period of indecision. When traders make decisions based only on candlesticks, they tend to make certain mistakes. Aspiring technical analysts have a tendency to see candlesticks in every price move. In reality, markets can be quite noisy. This means candlesticks alone may not be enough to reliably predict and analyze future price movements. By themselves, candlesticks provide a general idea of price action and show its final result, but they don't show in detail what happens between open and close prices or when the momentum began. This is why experienced analysts and traders will identify candlesticks in lower timeframes or use other technical indicators to confirm their candlestick analysis. Another common rookie mistake is ignoring support and resistance levels when analyzing candlestick patterns. Instead of looking at random candlesticks, traders sometimes focus on the ones near major price levels. For example, if the trend reversal candlestick pattern occurred near the resistance level, it can potentially make a bearish signal more valid. The market can be unpredictable, and it's important to keep this in mind when anticipating how a candlestick pattern will form. Making trading decisions based on candlesticks before they close may lead to hasty decisions. Furthermore, some patterns may need an additional candlestick in the required direction for confirmation. As a result, traders should be patient and make sure the candlestick is closed and the pattern is confirmed before executing a trade based on it. Want to learn more about trading cryptocurrencies? Subscribe to our YouTube channel by clicking on the subscribe button below. For more in-depth articles and guides, visit CEX.IO University. Link is in the description. Thanks for watching, and may the markets trend in your favor.